I have a large exposure to debt since I'm a risk-averse investor. What I really want to understand is how the falling interest rates will affect my portfolio.
Okay, so at the very basic level, if you were to look at a bond and assume that you have bought a bond today, the general interest rates in the economy were to fall over the next 6 to 12 months, your bond typically becomes more valuable because it is no longer available at that rate if someone were to buy it 6 to 12 months hence. So in that sense, since the value of the bond increases, it creates something that in bond markets we know as capital gains. Essentially, if you have bought a 100 rupee bond, then the value of the bond would be more than 100 rupees if the general level of interest rates in the economy decrease. When that happens, and now assume that you are not working on one bond but on a portfolio which is a collection of many bonds, the portfolio value itself would go up because there would be capital gains in the portfolio. And since price and yield have an inverse relationship, it basically means if the price of the bond goes up, the yield of the bond effectively comes down, so the yield on the portfolio comes down. As a rule, if interest rates in the economy are coming down, as an investor, you make capital gains because the value of your bonds goes up, but as a corollary, the yield of your portfolio comes down because you have already accounted for some part of your income that you were to get over the life of the bond on an immediate basis because you have got capital gains. To understand it the other way around, the only return that a fixed income instrument actually gives you is the coupon or the interest rate. The capital gains that occurs and which is upfronting of income essentially means that a part of that interest income that you were to receive over the say next 5 to 10 years, you have got it upfronted in form of capital gain today, and has essentially the remaining returns will be lower than what would have been the case otherwise.
I've seen a strong rally in the debt market over the last year. What has caused that, and will it be sustainable going forward?
The strong rally that we've seen in 2016 is but a continuation of a very secular kind of a bull run that we have seen in the interest rate markets in the last 18 to 24 months. This is supported by very, very strong and fundamental reasons. Essentially, if I were to name one or two of the most important reasons, the first would be a significant drop and a sustainable drop in inflation. The consumer price inflation has dropped from an average of 10-11%, which was the case between 2011 and 2014, to around the 5% mark as of today. And the second reason has been the significant improvement in the fiscal health of the government, given the fact that the government is the biggest issuer of bonds in India and the fiscal health has seen a meaningful improvement. That has ensured that the supply of government paper and the supply of quasi-government paper has been less as compared to the demand that we are seeing across the rate markets. The third and possibly the factor that has played a significant role this year in particular has been improving liquidity conditions. Because we have as an economy become more comfortable with a lower range of inflation, and because the government has been working very hard towards controlling inflation, the central bank, which is the Reserve Bank of India, has felt comfortable enough to provide more liquidity to the system. This is also done to ensure that the 150 basis point of rate cuts that the RBI did in the last 18 months are transmitted well. So a combination of fundamental factors, which is low inflation and a very sustainable reduction in fiscal deficit, improvement in the quality of government expenditure, accompanied by the fact that liquidity in this system has significantly improved in the last 12 to 18 months, has ensured that we have seen this sustainable rally. And we believe very strongly that till these fundamental factors do not alter or do not change from here on, and if at all we see any change, we only see change for further improvement in these parameters from here on. So as long as we continue to see status quo or further improvement, the fundamental support to rates will be there. And since the RBI is also supportive on the liquidity parameters, we will continue to see a meaningful and constructive movement as far as rates are concerned, which essentially means there is a potential further decline in interest rates that we could see over the next 12 to 18 months.
Which funds are best suited for low-risk debt fund investors over medium to long term?
So for investors who have say a time horizon of 2 to 3 years and beyond, and who don't want to have too much risk when it comes to returns in their product, they need to concentrate on funds which have reasonable accrual as in major part of the overall investor return comes out of the accrual returns coming from that product. The funds that would be most suited for these type of investors then would be accrual focused products, which in case of Reliance would be the Reliance regular savings fund debt and the Reliance corporate bond fund. One thing that differentiates them is the fact that when you are staying invested for 2 to 3 years, since these funds themselves run a duration in a range of 1.5 to 3 years, the interest rate risk in these portfolios is minimal for any investor who is staying for this duration or for a longer duration.
Which funds would you recommend for a retail debt investor, and if he's willing to take a bit more risk for maximizing debt returns?
If I were to step back a second and talk about the two major risks or the two fundamental risks that you have in any debt product, you have interest rate risk and credit risk. Interest rate risk is directly correlated to the average maturity of the fund, and credit risk, obviously, as the name suggests, is linked to the credit quality of any portfolio. From an investor standpoint, when it comes to retail investors, clearly with the fact that the fund has a lot of research focus, credit research focus in terms of ensuring that the credit risk is always kept at manageable levels. At the end of the day, when the investors are investing in accrual portfolios or the so-called credit portfolios, a lot of credit risk mitigation already happens because of good credit selection, because of decent choice amongst papers, and because of very robust structuring. I would suggest that retail investors should typically come into these type of accrual products for a major part of their allocation. However, there could be a class of investors who may not be willing to look at any amount of credit risk in their portfolios, but at the same time would be willing to take interest rate risk in their portfolios, which is also called as duration risk. So for investors who want to typically benefit more from a rise or fall in interest rates and are happy to stay in portfolios where such rise and fall could actually potentially create capital gains or losses, they should come into products like Reliance Securities Fund or Reliance Dynamic Bond Fund. These are the two portfolios which are focused much more in terms of running long duration and hence pass on the benefits that could come when interest rates are coming down.
Thank you. If you have any questions, write to us on this email ID, or you could also follow us on Twitter. The details of the same are mentioned on the screen. Thank you so much and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.